Welcome to all of you, Shiksha 360. And in this session, we will discuss very important, that is chapter number 9. And if you are able to understand the chapter number 9, that is basically you are able to understand chapter number 11, 12, 13, 14, along with that 28, 29. Clear? Because many of the concept is repeated under that. Clear? Very important topics for the examination point of view, and direct straightforward question you will get in the examination. Basically, chapter number 9, it is that type of chapter from in which you will get basically, I can say that 4 to 5 marks question. Clear? From single chapter, you will get 4 to 5 marks question. Clear? And that are very easy questions. Clear? And that are also very easy questions. Okay, so let's move towards the topic. So chapter number 9. So chapter number 9, basically it is related to the risk in banking business. Clear? Chapter number 9, it is related to the risk in the banking business. Risk in banking business. Clear? Please understand, please. Risk in banking business. So under that, clear? So under that, first thing which we have to discuss here is risk in banking business. Clear? Basically there are banking business lines. Clear? Banking business lines basically divided into 3 parts. Clear? Banking business lines basically divided into 3 parts. Can anyone tell basically in which 3 parts it is to be divided? Banking business lines basically divided into 3 parts. Clear? First one is the banking book. Second one is the trading portfolio or trading book. Third one here is to the off balance sheet exposure. Off balance sheet exposure. Okay. So first question you will get in the examination, basically banking business lines. Clear? Banking business lines is divided basically into 3 parts: banking book, trading portfolio, off balance sheet exposure. Okay. Next thing basically which you will get in the examination, that is what are the risks associated with these. Clear? What are the risks associated basically with these? So first of all, we have to discuss regarding the banking book. What are the risks under the banking book? Clear? What are the risks associated with the banking book? First one is a liquidity risk. Liquidity risk. Second one is the interest rate risk. Clear? First one is the liquidity risk. Second one is the interest rate risk. Third one is the default or credit risk. Default or credit risk. One here is to be the operational risk. Clear? Fourth one here is to be the operational risk. Clear? Please remember that in the banking book, market risk is not present. Clear? In the banking book, basically market risk is not present. Clear? Market risk is in the trading book. Clear? Basically market risk, it is basically in the trading book. Clear? Please remember one thing. Clear? Many times basically we are think that basically market risk. Clear? Especially market risk basically it is under the trading book or trading portfolio. So under the trading book, basically what risk we have? First of all, the differentiate between both, that is market risk. Clear? Market risk. Second one here is to be the liquidity risk or market liquidity risk. Third one is the default or credit risk. Fourth one is the operational risk. Clear? Fourth one is the operational risk. So please remember. Clear? So please remember one thing. Sometimes basically they will ask basically under the banking book or the trading book, just only one risk is differentiate between them, that is interest rate risk. Clear? In the banking book, interest rate risk is present, and in the trading book, market risk is present. Rest three risk is common to both of them. Clear? Now, next one is the off balance sheet exposure. Off balance sheet exposures. Clear? Next one is the off balance sheet exposure. Clear? So under the off balance sheet exposure, what we have to include it? Clear? Under the off balance sheet exposure, basically what we have to include it, under that we have to include bank guarantee, letter of credit, credit lines, backup credit lines. Clear? All these things are basically included under the off balance sheet exposure. Clear? Off balance sheet exposure. And what are the risks involved under that? Clear? What are the risks involved under that? First one is the liquidity risk. All risks are present under that. Clear? Liquidity risk, interest rate risk, default or credit risk, operational risk, and market risk. Clear? All risks are to be present under the off balance sheet exposure. Clear? Under the off balance sheet exposure, all risks are to be present. Clear? All risks are to be present here. Okay. So now move to the next one. Clear? Now move to the next one. Clear? This is the basic, that is banking business. Clear? Risk in the banking business. Clear? Now move to the next one. What are the different risks? Clear? What are the different types of risk? First one is the liquidity risk. Clear? First one is the liquidity risk. Very, very important. Definitely you will get one question from that in the examination. Clear? Very, very important from the examination point of view. That is a liquidity risk. Clear? Basically liquidity risk, when it arises. Clear? Liquidity risk basically when it arises, basically when the bank or bank's inability. Clear? Or bank's inability basically for what? For meeting cash flow obligations. Clear? Bank's inability basically for meeting cash flow obligations. Clear? Cash flow obligations. That is basically known as the liquidity risk. Clear? That is basically known as a liquidity risk. And what is the important point under that? Basically it's a types. Clear? Basically it's a types. Clear? So basically what are the three types under that? First one is the funding risk. Clear? First one is the funding risk. Clear? Basically funding risk, it is when funding risk, I will write it both. Second one is the call. Third one is the time. So basically when there is funding risk. Clear? Basically funding risk is at that time basically when bank is not able to pay the money. Clear? Funding risk, it is that time basically when bank is not able to pay the money. When bank is not able to pay the money. And second one is time risk. Clear? Basically time risk. Basically when time risk, basically when customer is not paying the money. Clear? Customer is not paying the money. I will tell you the example so that it's more clear to you. Clear? First one is the funding risk. That is basically when bank is not able to pay the money. Third one is the time risk. Clear? That is basically when customer is not able to pay the money. Clear? So when funding risk arises. Clear? So when funding risk arises, basically unanticipated withdrawal. Clear? Basically unexpected withdrawal, unanticipated withdrawal. Or second one, premature closure of term deposits. Clear? Or premature closure of term deposits. Clear? Or premature closure of the term deposits. In that case, funding risk, it is to be allowed. Clear? Basically funding risk, it is to be allowed. Clear? So basically when time risk, basically when there is non-receipt of. Clear? That is non-receipt of expected inflow of funds. Clear? Non-receipt of expected inflow of funds. Clear? Non-receipt of expected inflow of funds. That is basically known as the time risk. Clear? That is basically known as the time risk. Clear? And last one is the call risk. Clear? Basically call risk, basically we can say that crystallization of contingent liabilities. Clear? Contingent liabilities. Like that is bank guarantee. Clear? Like bank guarantee. Okay. This one is very, very important for the examination point of view. Clear? Definitely you will get questions from that in the examination. Clear? Definitely you will get questions from that in the examination. Okay. So please tell fast. It is clear to all of you. All these 3 points, it is clear to all of you. Under the liquidity risk, basically we have 3 risks: funding risk, call risk, and time risk. Clear? different types of question will be formulated on all these things. So please take care while answering all the questions. Now move to the next one. Now move to the next one. Next one is interest rate risk. Clear? Interest rate risk. Clear? This thing basically you will get interest rate risk in the chapter number 9 also, in the chapter number 22 also, in the chapter number 29 also. Clear? In the chapter number 29 also. Clear? You will get at all the three places these points. Clear? You will get interest rate risk basically at all these three places. Clear? And the chapter number 9, in the chapter number 22, and in the chapter number 29. Clear? Same thing they have given. Just you have to understand. Clear? So what is interest rate risk? Clear? What is interest rate risk basically? Risk of loss. Clear? Interest rate basically what is risk of loss due to adverse movement of interest rate. Clear? Due to adverse movement of interest rates. Clear? Due to adverse movement of interest rate, that is interest rate risk. Clear? That is interest rate risk. Clear? Next thing which you will get in the examination basically, what are the different types? Clear? Basically what are the different types under that? Clear? What are the different types under the interest rate risk? So let's discuss one by one basically what are the different types under the interest rate risk. First one is the gap or mismatch risk. Gap or mismatch risk. Clear? Please remember, clear, in these types of questions, just you have to remember the definitions. Clear? Just you have to remember the definitions. So under that basically gap or mismatch risk. Clear? Basically name tells that basically when we have assets and liabilities. Clear? Basically when we have assets and liabilities having different maturity. Clear? Basically when we have assets and liabilities having different maturities, that is gap or mismatch risk. Like basically loan has maturity of 2 years. Loan has maturity of 2 years and fixed deposit has maturity of 6 months. Clear? Fixed deposit has maturity of 6 months. Clear? That is basically known as gap or mismatch. Clear? Gap or mismatch risk. Now next one here is to be second one which we have to discuss, that is basis risk. Clear? Second one which we have to discuss here is basis risk. Clear? Basically basis risk, that is interest rate of different assets and liabilities. Clear? Interest rate of different assets or liabilities may change in different magnitude. Clear? Interest rate of different assets and liabilities basically may change in different magnitude. Clear? May change in different magnitude. That is basically known as the basis risk. Clear? So what is the meaning of that? Like loan interest rate, it is increased by, we can say that 3% or 4%. On the same hand, borrowings, here basically like we can say that by 2 or 2.5%. Clear? So that is basically there is mismatch. Clear? There is mismatch. This type of mismatch, it is known to be as the basis risk. Clear? Basically known as the basis risk. Next one here, third one is to be the, yes, one student say that yield curve risk. Clear? Yield curve risk. Many students basically are not able to understand basically what is yield curve risk. Clear? Basically yield curve risk, it is basically, it is an internal rate of return. Clear? Yield curve risk basically it is internal rate of return on securities. Clear? It is internal rate of return on securities. Okay, it is basically internal rate of return on securities. Clear? And here basically we have to just remember the example of, treasury bill. Clear? Just remember the example of treasury bill. Clear? 91 days and 364 days. Clear? Basically it is basically that when bank adopts different benchmarks. Clear? Basically when banks adopts different benchmarks for their assets and liabilities. Clear? Basically when bank adopts different benchmarks basically for their assets and liabilities, at that time basically the risk arises, that is to be known as the yield curve risk. Clear, the risk at that time which is arising, that is to be known as the yield curve risk. Clear. Next one is very, very important, which we have discussed in the today morning MCQ discussion also, that is embedded option risk. Clear, basically embedded option risk. That is, it is related to the either loan payment is prepaid or fixed deposit premature. Clear, fixed deposit premature. Clear, that is basically known as the embedded option risk. Clear, that is basically known as the embedded option risk. Clear. And one thing very, very important, there is one line under that, the faster, and please remember this line, faster and higher the magnitude. Clear, faster and higher the magnitude of changes in interest rate. Clear, faster and higher the magnitude of changes in interest rate. So what will be the embedded option risk to the bank? Net interest income to the NNI, it will be more or less faster and higher the magnitude of change in the interest rate. What impact on that? What impact basically to the bank's NII, net interest income? What is the impact? Greater impact or lesser impact? Clear, basically faster and higher the magnitude of change in the interest rate, basically higher, we can say that basically greater or more, greater or higher the impact. Clear, greater or higher the impact. Clear, because either the interest rate is increase or decrease. Clear, it depends. Clear, so basically it has more impact. Clear, if the interest rate is decrease. Clear, so basically people start taking money from the fixed deposit and want to invest in other places. Clear, basically where they will get more return. Clear, on the other hand, if the loan rate is increasing, clear, loan rate is increasing, so basically what basically mind in going on in the minds of the people, basically like we have to prepayment our loan. Clear, we have to prepayment our loan so that we have to pay less interest rate. Clear, we have to pay less interest rate. Clear, so very, very important point. Clear, one more question, very, very important. Hope this question is clear to all of you. At this point it is clear to all of you. Now next one here is to be, we have discussed 4 risk. Now next one which we have to discuss here, that is reinvestment risk. Clear, fifth one is the reinvestment risk. Clear, fifth one here it is to be the reinvestment risk. Clear, next one, that is reinvestment risk. Clear, that is basically future cash flows. Clear, it is regarding the at which rate, basically interest rate at which future cash flows could be reinvested. Clear, rate at which future cash flows basically could be reinvested. Clear, could be reinvested. Clear, that is basically known as the reinvestment risk. Clear, that is basically known as the reinvestment risk. Okay, next risk which we have to discuss here is that is market risk. Clear, next risk which we have to discuss here is market risk. Market risk. Clear, under that basically one risk it is left, that is net interest position risk. Clear, net interest position risk. Net interest position risk. Okay, so now next is market risk. Clear, now next which we have to discuss here, that is market risk, and it is very, very important. Clear, market risk. Clear, so what is market risk basically? That is basically regarding to the trading portfolio. Clear, market risk basically it is regarding to the trading portfolio. Clear, so basically under which thing basically you will get market risk, like this one is the basically practical example, like equities, commodities, currencies. Clear, so under all these 3 things, clear, basically under all these 3 things basically you will find the market risk. Clear, basically due to the adverse market condition you will get the market risk basically under all these 3 conditions. Okay, next one which we have to discuss here is that is credit or default risk. Clear, basically credit or default risk. Clear, next risk which we have to discuss here, that is credit or default risk. Clear? Just you have to remember the definitions. Clear? Just you have to remember the definitions under that, which you will expect it in the examination. Clear? Which you will expect in the examination. That's why I'm saying that just you have to remember the definitions here. So under the credit risk, basically there are two types of the risk. First one is the counterparty risk. Second one here, it is to be the country risk. Clear? First one is the counterparty risk. Second one is the country risk. Clear? Basically country risk. Clear? So basically what is the country risk? Clear? Basically country risk, it is basically non-performance by a borrower. Clear? Under the countries, that is non-performance by a borrower or a counterparty. Clear? Basically why? Basically due to the some restrictions. Due to the restrictions arises in that country. Clear? Basically due to the restrictions basically arises in that country. Clear? That is basically known as the country risk. Clear? And please remember that. Clear? Country or default risk basically it is comes under the country risk or counterparty risk. It is comes under the default or credit risk. Clear? Default or credit risk. Clear? Next one is a counterparty risk. Clear? Basically counterparty is that is basically non-performance of the trading partners. Clear? Non-performance of the trading partners. Clear? That is also basically one of the counterparty risk. Clear? That is basically counterparty risk. Clear? So here basically in that, if you go with the definition, clear, here they will discuss one word, that is call money. Clear? So basically there are three types of money. One is call money. Second one is notice money. Third one is term money. Clear? So can anyone tell basically what is the duration of the notice money and term money? Clear? So can anyone tell basically what is the duration of the notice money and the term money? Notice money, it is basically from how many days to how many days, and term money basically from how many days to how many days. Clear? Notice money is basically 2 to 14 days. Clear? 2 to 14 days. Clear? Please remember that 2 to 14 days basically it is notice money, and term money it is basically from 14 to 365 days. Clear? 14 to 365 days, that is basically term money. And call money, it is also known sometimes basically it is also known as overnight money. Clear? It is also known as overnight money. Clear? That is basically for the 1 day. Clear? Overnight money, that is basically for the 1 day. Clear? That is basically comes under the call money. Clear? That is basically comes under the call money. 1 day, notice money 2 to 14 days, term money that is 14 days or more than 14 days, we consider 14 to 365 days. Clear? That is basically regarding the count different types of money. Clear? Next thing which we have to discuss here is operational risk. Clear? Operational risk. Okay, so under the operational risk, what is basically risk of loss? Clear? Resulting from the inadequate or failed internal processes. Clear? Resulting from the inadequate or failed internal processes. Clear? Internal processes. Like we can say that like server failure or network issue. Clear? In that basically natural calamities like earthquake, it is also under that. Clear? Basically it is also under that. Clear? It is also basically part of the operational risk. Clear? It is also basically part of the operational risk. Clear? So basically operational risk, basically we can say that it is any type of the risk basically which we will not included under the other risk. Clear? We will not included the another under any other risk. Clear? So we can include that risk basically under the operational risk. Clear? So in that we have to discuss basically some different risks like transaction risk, second one here it's to be compliance risk, here transaction risk and compliance risk. Clear? Basically transaction risk basically it is risk arising from the fraud. Clear? Basically transaction risk basically it is that risk basically which arises from the fraud, and that for fraud it is either it is to be internal or it is to be external. Clear? And that fraud it is basically either it is to be external or internal. Clear? Next one is the compliance risk. Clear? Next one is the compliance risk. Clear? Compliance risk basically it is also known as compliance risk basically it is also known as the integrity risk. Clear? Very, very important. Compliance risk basically it is also known as, sometimes basically it is also known as the integrity risk. Clear? It is also known as the integrity risk. Clear? Why? Because if bank is not compliance to the guidelines, clear, if the bank is not following the guidelines, so basically it leads to, basically we can say that, falling in the bank's reputation, clear, basically falling in the bank's reputation, clear. That's why basically this risk, it is also known as the integrity risk, clear. Basically what is the risk? Basically it is the risk of legal or a regulatory sanction, clear, legal or a regulatory sanction. Okay, that is basically known as the compliance risk, clear, that is basically known as the compliance risk, clear. Next one which we have to discuss here, that is reputation risk, clear. Next risk which we have to discuss here, that is reputation risk. Clear, reputation risk, basically that is basically risk arising from the negative public opinion, clear, basically risk arises from the negative public opinion, that is basically known to be as the reputation risk, clear, that it is to be known as the reputation risk. So please tell fast all the different types of risk. It is clear to all of you or not? Please respond fast if you have any doubt, any query regarding the different type of risk, clear, regarding the different types of risk. Okay, so here in the nutshell, basically we can say that this one is very, very important for the examination point of view. And please remember, clear, please remember all these risks so that you are able to remember all these points in the exam time of the examination, clear. You are able to answer the question. Okay, and tomorrow basically we will discuss some important questions and I will provide you the some questions on that. And in the meanwhile, basically I will discuss one thing, that is basically what is Alsman Z score, clear. One important, that just simple Alsman Z score, clear, that is very, very important for the case study point of view, clear, case study point of view, or 1 or 2 mark question also, clear. Alsman Z score, clear, just one equation is given of the Alsman, clear. So can anyone tell basically what is the equation? What is that equation given by the Alsman? That is Z. It is a, first of all, you have to remember that basically it is model basically for the US manufacturing firms, clear, US manufacturing firms. And what it tells, this is basically from chapter number 12, and what it tells, clear, basically what Z's Alsman Z score basically what tells it expresses, very, very important, what is the meaning of that? It expresses the measure of the default, clear, it expresses the measure of the default, clear. What it expresses, basically it expresses the measure of the default, that just many students are giving the character Z is equal to 1.2x1 plus 1.4x2 plus 3.3x3 plus 0.6x4 plus x5, clear. Or we can say that 1 into x5, or generally you can write it x5, clear, generally you will write as x5, clear. I will provide you 3 to 4 case studies on the basis of that. You have to go on through all these case studies and try to understand basically how to solve that case studies, clear. I will provide you the videos in the group, clear, regarding that. And one thing more, clear, basically regarding the Z score. Basically, if the Z score is going to continuously higher the Z score, clear. So basically, lower the borrower default risk or higher the borrower default risk, clear. As the Z score is going to rise, so there will be low risk or there will be high risk, clear. So higher the Z score, basically lower the borrower default risk, clear, lower the borrower default risk, clear. So just what you have to remember, that basically there it is an inverse relationship, clear, there it is an inverse relationship, clear. As the Z score basically it is less than 1.81, it means that basically it is a high risk borrower, and the value of Z is basically we can say that greater than 3, so it leads to the, it is the meaning that it is a low risk borrower, clear, it is a low risk borrower. Okay, so this is the overview of the chapter number 9, and this also help you, clear, this also help you to understand another topics, clear, another chapters, like we can say that 11, 12, 13, 14, clear, because all these chapters are basically one by one discussion of all these risks, clear, one by one discussion of all these risks. And chapter number 28, 29, chapter number 22, clear, all are interlinked, clear, all are interlinked, clear. So go through the chapter number 22 also, clear, go through the chapter number 22 also, that is basically regarding to the interest rate, clear. Under that basically there are some basic discussions clear, that is basically regarding to the asset and liability management clear. But under that, in the end clear, we have net interest income clear, we have net interest income clear, net interest income clear, that is related to little bit that clear regarding the risk clear. And chapter number 29, 28, 29 clear, that is 28 chapter number is regarding the liquidity risk, and chapter number 29 is interest rate risk management clear. So please go through both these topics properly. So thanks to all of you for joining this session. Tomorrow we will provide you some more MCQ discussion in the morning session, and in the evening session we will discuss some another topics clear. And tomorrow I will provide you 5 to 6 chapters MCQ discussion clear in the group in the form of the quiz, so that you are able to practice all the chapters. And thanks to all of you for joining this session.